You know, if you're an investor here in the US, I could probably guess a huge chunk of what's in your portfolio right now. I'm talking Apple, Microsoft, Amazon, Google, all the big names, right? And hey, let's be honest, for the last decade, that's been an absolutely winning play. It feels safe, it feels smart, and the returns, they've been fantastic. But what if that comfort, that familiarity, is actually hiding a pretty big risk? What if the strategy that's been working so well for so long is actually setting you up for a letdown? Okay, let's really get into this.
This right here is the question, the most important one we're going to tackle. This isn't about doom and gloom or predicting a crash, not at all. It's about looking at your money through a totally different lens. We're going to dig into the numbers, we're going to challenge some really common ideas, and explore why looking beyond our own backyard isn't just some kind of niche strategy, but actually a crucial part of building a portfolio that's really made to last. And it all starts with this powerful kind of invisible psychological pull that gets almost every single one of us.
And that invisible pull, it has a name, home bias. Kinda sounds harmless, right? Cozy even, like rooting for the home team. But when it comes to investing, this bias is a well-known trap. It's a tendency that feels so right, but it can lead you to take on way more risk than you even realize, and it could cost you big time in missed opportunities, making your financial journey a whole lot bumpier than it needs to be.
So what is it exactly? Well, at its heart, home country bias is just our natural human instinct to stick with what we know. I mean, think about it. You see McDonald's golden arches, you shop at Walmart, you hear about the S&P 500 every single night on the news. All that exposure makes us feel comfortable. It makes us feel safe. We start to think, hey, I know these companies, so I must have a better handle on the investment. But here's the problem. That feeling of comfort has pretty much zero connection to the cold, hard math of the global stock market.
And this chart shows you that math perfectly. Imagine the entire world of stocks as one big pie. That huge slice, about 60%, that's the US stock market. Yeah, it's the biggest in the world, no doubt about it. But I want you to really focus on that other slice, that 40%. That's every car company in Japan, every luxury brand in France, every cutting-edge drug company in Denmark. It's a massive universe of innovation and growth that is completely outside the United States. So knowing the world is split about 60-40, how do American investors actually put their money to work? Well, this right here is the reality check. The average U.S. investor's portfolio is not 60-40. It's more like 80% U.S. stocks and only 20% international. And for a lot of people, it's even more lopsided than that, like 90-10 or even 100% all in on the USA. The disconnect is huge. It's like we're looking at that global buffet of opportunity and just ignoring nearly half of it, piling our plate high with only the stuff that's closest to us. And that leads to this critical point. Putting 80 or 90% of your money into U.S. stocks isn't diversification. It's actually the opposite. It's concentration. It's a massive, high-stakes bet that one single country, the United States, is going to keep crushing every other country on Earth forever. And listen, the U.S. is an incredible economic powerhouse, but history has a very clear and very humbling lesson for anyone who thinks one country can stay on top forever. Yeah, this is where we need to let history be our guide. This idea that America is always the best place to invest is a classic trap called recency bias. It just means we take what's happened lately and assume it's going to happen forever. But investing is a long-term game. And when you zoom out and look at decades of data, a really clear pattern shows up. Market leadership is not permanent. It rotates.
And this table shows you that rotation in black and white. Let's just walk through it. Look at the 1980s. The big story was Japan's economic boom. The S&P 500 did great, returning almost 18% a year. But international stocks, they did even better, over 20% a year. International was the winner. Now, jump to the 2000s, what many call the lost decade. The U.S. got hit by the dot-com bust and the financial crisis, and its average return for the entire decade was negative. Meanwhile, international markets kept chugging along with positive returns. Again, international won. And of course, the 2010s. That was the decade of U.S. dominance, driven by big tech, where the S&P 500 just stomped everything else. The lesson is crystal clear. No one stays on top forever.
I really want to just pause on this number for a second, because it's so important. An average annual return of negative 0.95%. Think about what that means. For an entire decade, from January 1st, 2000 to the end of 2009, if you had all your money in the U.S. stock market, you made nothing. In fact, you lost money. Imagine saving and investing diligently for 10 years, a huge part of your career, only to end up with less than you started with. That is the real, tangible risk of putting all your eggs in one country's basket.
Okay, so we've been talking about the defensive reasons for going global, managing your risk. But that's only half the story. Let's switch gears from playing defense to playing offense. Because when you only invest in the S&P 500, you're not just concentrating your risk. You are actively choosing to leave some of the best, most dominant companies in the entire world off of your team.
I mean, think about the phone or computer you're using right now. The chip inside it was almost certainly made using a machine from a Dutch company called ASML. They have a total monopoly on the most advanced machines. Nobody else can do what they do. Or what about luxury goods? Louis Vuitton, Dior, Tiffany, that's all one French company, LVMH. Or the revolutionary new weight loss drugs. The world leader is Novo Nordisk out of Denmark. These are not small-time players. These are global champions that are totally absent from a US-only portfolio.
And this brings us to what is probably the single biggest, most dangerous misconception out there. I hear it all the time. Hey, I own Coca-Cola, I own Apple, they sell stuff all over the world, so I'm already diversified. You know what? It sounds perfectly logical. It feels like it should be true. But from an investing standpoint, it's a myth. And it's a myth that can give you a false sense of security. Let's break down exactly why.
This slide nails the key differences. Even though Apple sells iPhones in Paris, its stock price moves based on what happens in the US market. It reacts to US inflation, US interest rates, US investors. And crucially, it has a very high correlation with the S&P 500. Correlation is just a fancy word for how two things move together. When the US market has a bad day, Apple almost always has a bad day too. But a true international stock like LVMH, it moves to the beat of a different drum. It's driven by European and Asian economies, it's priced in euros, and most importantly, it has a much lower correlation to the US market. That's where the magic of diversification comes from, owning things that don't all go up and down for the exact same reasons. Okay, so hopefully the why is becoming super clear. You lower your risk, and you get access to this whole world of amazing companies. So the next question is, okay, how do I actually do it? This might sound complicated, and you know what? 20 years ago, it was. You needed special brokers, it was expensive, but today, technology has made it incredibly simple and cheap for anybody to build a global portfolio in just a few minutes.
It really just comes down to these 3 simple steps. First, just decide how much of your stock portfolio you want to have outside the US. There's no single magic number, but most experts suggest somewhere between 20 and 40%. Step 2, choose your vehicle. And for almost everyone, the best tool for the job is an exchange-traded fund, or ETF. And third, just check in once a year. See if things have gotten out of whack and make a few small tweaks to get back on track. That's it. Simple.
And here are some of the most common tools people use. So, what's an ETF? Just think of it like a basket that holds hundreds or even thousands of different stocks. You can buy one share of the whole basket just as easily as buying one share of Apple. A fund like VT is the ultimate easy button. You buy that one thing and boom, you own pretty much every stock in the world, US included, all in the right proportions. Or if you want a little more control, you can use something like VXUS, which holds all the international stocks except for the US ones. It's a perfect partner for your existing US funds.
So, let's bring it all home. What's the real goal here? It's not about being unpatriotic or betting against America. It's not even really about trying to chase higher returns, although that can happen too. The ultimate goal is just to build a stronger, more resilient, all-weather portfolio. It's about taking advantage of the one thing that a Nobel Prize-winning economist famously called the only free lunch in investing.
And this chart shows you that free lunch in action. A US-only portfolio has its own ups and downs. That's volatility. An international-only portfolio also has its ups and downs, but they happen at different times for different reasons. Now look what happens when you combine them. Because they're not moving perfectly in sync, they kind of cancel out each other's extreme moves. The result is a smoother ride, less overall volatility. It's like having better shock absorbers on your car. The road is still bumpy, but the journey for you is a lot less stressful. And that makes it so much easier to stay the course and let your money grow.
And that is exactly what Harry Markowitz was talking about. His work basically created modern investing theory. And the free lunch is this idea that by combining things that don't move in lockstep, like US and international stocks, you can potentially get similar or even better long-term returns, but with less risk along the way. You just get a more efficient portfolio, a better bang for your buck. It is one of the most powerful ideas in all of finance.
So if you only take one thing away from all this, let it be this. Going global isn't a bet against the United States. It's really just an admission that you don't own a crystal ball. Nobody does. It's about building your portfolio so that you're set up for success no matter which country or region ends up leading the world over the next 10 years.
You'll own a piece of the action, wherever it's happening.
And that brings us right to the final big question. After an incredible run for the U.S. market, would the next 10 years be more of the same? Or is leadership going to rotate again just like it has so many times before? Will things like lower valuations and different population trends overseas finally cause that pendulum to swing back?
And the beautiful answer to that question is that a truly diversified global investor doesn't have to care. You don't have to guess. You don't have to read the tea leaves or make predictions. You've built a portfolio for all seasons. You haven't bet on one horse to win the race. You've bought a ticket on the entire field. And that is the quiet confidence that comes from looking beyond your own borders.